Asset, that's anything you own that has value and, ideally, puts cash in your pocket or appreciates over time. Think of your house, a car, your savings, or investments. On the flip side, a liability is anything you owe that takes cash out of your pocket, like your mortgage, credit card debt, or student loans. These are your financial obligations, the things you have to pay back. Now, combine those two and you get your net worth. It's simply your assets minus your liabilities. This is what you're truly worth, financially speaking. Income. This is the money coming in, whether it's from your job, a side hustle, investments, or even that lucky lottery ticket. Conversely, an expense is money going out, everything from your rent and groceries to that daily coffee run. And what's left after income covers expenses. That's your profit, your savings, or disposable income. It's the good stuff, the money you get to keep and grow. Ever notice how your favorite chocolate used to cost less? That's inflation in action. It's the slow-motion tax that gradually erodes your purchasing power, making everything just a little bit more expensive every year. It's why $1 today is usually worth more than $1 tomorrow. But here's something awesome that fights inflation: compound interest. It's interest on your interest, the snowball effect that can either work miraculously for you in investments, making your money grow exponentially over time. Credit score? Think of it as your adult GPA. This 3-digit number tells lenders how responsible you are with borrowed money. Pay your bills on time. When you take out a loan, you'll hear about APR, or annual percentage rate. It's the real yearly cost of a loan, including all the fees and charges bundled in. And how do you pay off a big loan like a mortgage? Through amortization. This is the process of paying off a loan a little each month, with each payment chipping away at both the principal and the interest, ensuring the loan is completely paid off on a preset schedule. Life throws curveballs, right? That's why you need an emergency fund. It's your cash cushion, typically 3 to 6 months of living expenses. And speaking of cash, liquidity refers to how fast you can turn an asset into cash without taking a huge loss. Cold, hard cash is the most liquid asset. Real estate, not so much. Remember that idea about $1 today versus $1 tomorrow? That's the time value of money. $1 today beats $1 tomorrow, hands down, because you can invest it, let it compound, and make it grow. Now, the opposite of inflation is deflation, when prices drop and your dollars temporarily feel like super dollars. While it sounds great, widespread deflation can actually be a sign of a struggling economy. If you ever need to borrow a significant amount, a lender might ask for collateral. This is an asset, like your car or house, that the bank can grab and sell if you stop making your payments. It's their insurance policy. Which brings us to a mortgage. It's simply a loan you take out to buy a home, and the home itself serves as collateral. Your equity in that house is your ownership stake, what your place is worth minus what you still owe on the mortgage. As you pay down the loan or the property value increases, your equity grows. Finally, capital is simply money or assets you use to make more money. The interest rate is the price tag on borrowed cash, the cost you pay for using someone else's money. And a loan, that's someone else's money you promise to return, usually with a little extra tip called interest, for the privilege of using it. Let's talk about how you can put your money to work. First off, a stock. It's literally a tiny slice of ownership in a company that you can buy with just a few clicks. When you own a stock, you become a part owner. Then there's a bond. You're lending money to a government or company, and in return, they promise to pay you back your original money plus a fixed amount of interest over a set period. They're generally considered lower risk than stocks. An ETF, or exchange-traded fund. It's like a basket filled with many different stocks or bonds that trades on a stock exchange, just like a single stock. A mutual fund is similar, but works a bit differently. It's a professionally managed pool of money for many investors, used to buy a diversified portfolio of stocks, bonds, or other securities. You buy shares of this pool, and fund managers make the buying and selling decisions for you. Now, let's talk retirement. An IRA, or individual retirement account, is a special retirement bucket with fantastic tax perks. There are different types, like a traditional IRA, where your contributions might be tax deductible, and your money grows tax deferred until retirement. Then there's the Roth IRA. Same retirement bucket, but with a twist. You fund it with money you've already paid taxes on, and in exchange, all your qualified withdrawals in retirement are completely tax-free. A REIT, or Real Estate Investment Trust. It's a company that owns, operates, or finances income-producing real estate. You buy shares, and you effectively collect rent and participate in property appreciation without actually owning physical property. Venture capital involves big money bets on startups, those early-stage companies with massive growth potential. It's high risk, high reward, and usually for big investors. Similarly, private equity involves investors buying entire private companies, often fixing them up, improving their operations, and then flipping them for a profit. Again, typically for very large investors. A hedge fund. This is a fancy pool of money, often employing complex investment strategies to chase outsized returns. They use techniques like short selling and leverage, and they're usually closed to everyday investors, requiring significant capital and specific qualifications. Now, let's talk about the dynamic world of the markets, the kind of stuff you hear about on the news that makes you wonder what it all means. Market capitalization, or market cap. This is the total value of all a company's outstanding shares. It tells you how big a company is, small, mid, large, or even mega cap. Then there's volume. This is simply the number of shares or contracts traded for a particular security over a specific period, usually a day. High volume means a lot of people are buying and selling, which often signals significant interest or news surrounding that stock. Ever feel like the stock market is a roller coaster without seatbelts? That's volatility. It describes how violently and quickly prices swing up and down. High volatility can mean bigger potential gains, but also bigger potential losses, making it a thrilling yet nerve-wracking ride. Yield refers to the income an investment pays, shown as a percentage of its current price. It's super important for income-focused investors. To avoid putting all your eggs in one basket, you practice diversification. This means spreading your chips across different types of investments, industries, and geographies. It's about not betting the farm on one horse, aiming to reduce overall risk. And how do those investments relate to each other? That's correlation. It measures how two investments dance together. If one zigs when the other zags, they're negatively correlated, which is great for diversification. If they move in the same direction, they're positively correlated. When you're tracking your portfolio's performance, you need a benchmark. This is the yardstick your portfolio has to beat, usually a well-known index. It gives you a standard to compare against. To understand long-term growth, we often look at CAGR, the compound annual growth rate. It's the smooth annual growth rate that ignores all the ups and downs and bumps along the way, giving you a clearer picture of an investment's consistent performance over multiple years. For bonds, maturity is a key term. It's simply the specific date when a bond finally pays you back your original principal, ending the loan agreement. And speaking of bonds, the yield curve is a fascinating graph that plots interest rates of bonds from short-term to long-term maturities. If it inverts, meaning short-term rates are higher than long-term rates, recessions often start trending shortly after. Commodities are the raw stuff that keeps the world running. Think gold, wheat, crude oil, or natural gas. These basic goods are traded globally and can be a hedge against inflation. And then there's Forex, short for foreign exchange. This is the massive global market where currencies are constantly swapping partners 24/7. It's where the value of one country's money is exchanged for another's. Cash flow is pretty straightforward. It's money in minus money out. ROI, or return on investment, is what you get divided by what you paid. It's a simple metric to gauge the profitability of an investment, and generally bigger is always better. All right, if you're ever looking at a company and trying to figure out if it's a good investment, these are the critical numbers you need to understand. Revenue. This is the total amount of money a company generates from its sales of goods or services before anyone subtracts anything. EBITDA. This stands for earnings before interest, taxes, depreciation, and amortization. It's management's version of, look how much we made before real life got in the way. Take out just the depreciation and amortization, and you get EBIT, or earnings before interest and taxes. How much of that revenue actually turns into profit? That's your profit margin. It tells you how many pennies of profit survive from each dollar of sales. A higher profit margin indicates a more efficient and profitable business. Then there's EPS, or earnings per share. This is a company's total profit divided by the total number of its outstanding shares. The P/E ratio, or price-to-earnings ratio, is one of the most famous valuation metrics. It's the price per share divided by the earnings per share, and it tells you how much investors are willing to pay for $1 of a company's profit. A high P/E might suggest growth expectations, while a low one could indicate a bargain. Another ratio is the P/B ratio, or price-to-book ratio. This compares the stock price to the company's book value per share. For companies that aren't consistently profitable yet, the P/S ratio, or price-to-sales ratio, can be handy. It's the price per share versus the sales per share. It's often used for early-stage tech companies. ROE, or return on equity, measures how well the company turns its shareholders' money into more money. A dividend is a sweet perk. It's cash the company mails you just for owning its stock, typically paid out from its profits. Now, the holy grail for value investors is finding a company's intrinsic value. This is what a company is truly worth based on its future cash flows, regardless of its current market price. It's hard to calculate precisely, but it's pure gold when you find a company trading below its intrinsic value. Book value is what a company's assets are worth minus its liabilities, strictly on paper.